So in this video, we continue with our discussion on the basics of financial statements. And this video would be dedicated towards the profit and loss account. So what is also known as the income statement. This is a sort of a report card that gives us an idea about what the company has sold, what are the costs undertaken in selling that, and essentially the difference of between those two being the profitability of the firm. So that's what a profit and loss account or profit and loss statement stands for. Let's look at it in detail. Now, profits are a measure of a company's well-being and perceived value addition by the customer. The P&L account is a report card of the financial performance of the firm for a particular period. So remember, we had discussed that P&L accounts and cash flows are periodic statements. So P&L is a periodic statement. It gives you the performance of the company for a particular period, right? This period could be a year, this could be 6 months, this could be 3 months, it could be any tenure that you have chosen. So this is also known as P&L statement or income statement. The words earnings and profits are also used interchangeably, right? So that's broadly a straightforward basic definition of what a P&L statement or a profit and loss account looks like. Now let's understand that there are various definitions of profits that come out. First, let's kind of revisit our initial discussions. That balance sheet is as on a point of time, so that's a snapshot. And you have another snapshot, let's say after a year, of what the business health is. The business activity that the company has taken during the year, what it has produced, what it has sold, etc. All this is what is recorded in the profit and loss account of the particular company. It's one of the linking points of the two balance sheets, at the ending of the last year and the ending of this year, or beginning of this year and ending of this year. Now let's look at various views of profits that are available. Net sales are the revenues that you have earned. So essentially, sales are also known as revenues. This is what you earn by selling. This is the market price that you have earned, right? So this is the total selling price. This does not include the cost. Now, from this total selling price, if you remove the cost of goods sold, this is also known as COGS. Cost of goods sold is only the cost used in producing the goods. So only costs, incurred in producing the good slash service, right? So producing is what is cost of goods sold. So this might include raw material cost. This might include some component of salary cost. This might include some component of electricity, etc. And all that combined will essentially give you the total cost of goods sold. Once you subtract this, you get what is known as the gross profit. That's the gross profit of the organization. That if I'm selling a digital marker, and the cost that has gone in terms of producing that digital marker is known as the gross profit. If I find the sales and costs and the difference of those two, that is what is told as the gross profit. Now, from the gross profit, if I subtract the other expenses, what could be other expenses? Other expenses could be administrative in nature. Salary of, for example, salaries of people who are not directly involved in producing the good. Let's say someone in the HR department of the company. Those salaries. Other costs related to probably marketing, R&D, advertisements, which are not directly linked to the product, are all the other operational expenses. You subtract that, you get what is called as earnings before interest, taxes, depreciation, and amortization. This is known as EBITDA, or also commonly referred to as the operating profit of the business. Operationally, you have made certain costs. The COGS plus expenses give you the total costs that operationally have been taken. EBITDA is the earnings before interest, taxes, depreciation, and amortization. What is amortization? Amortization is depreciation for intangible assets. So remember, we had spoken about what depreciation is. Uh, that's the gradual usage of a particular asset, or the gradual decline in the value of a particular asset. That's for a tangible asset. If the asset is intangible, that's called as amortization, right? Now, that's called EBITDA or operating profit. Let's go ahead, and if we remove from this EBITDA the non-cash expenses, these are all non-cash expenses. Why are they non-cash expenses? Is because there is no outflow of cash that happens in accounting for depreciation and amortization. Once you remove that, you get earnings before interest and tax, also known as EBIT or PBIT, which is profits before interest and tax. Uh, a lot of your foreign textbooks also call this as a measure of operating profit. So you could use operating profit interchangeably for EBITDA or for EBIT. Anything is fine, right? Now, from EBIT, which is earnings before interest and taxes, if you remove the interest component, what is left? Interest goes to the debt holders of the company, the guys who have given the debt to the company. What is left is earnings before tax or profit before tax. Now, why is this coming here? Is because interest is, you get a tax shield on interest, which means you don't pay taxes on the amount of the interest that's considered as a cost. And because you remove the cost before arriving at a measure of profit, which is profit before tax, on this, the stipulated tax regime gets applied and you put up the tax there. The tax put up gives, after you remove the tax, you get profit after taxes, net profit, also known as net income of the business, right? So PAT or net profit or net income of the business is the final view of the profit. Now, there are different views, and as an analyst, you probably need to look at all of these, but sometimes certain specific parameters become more important for certain kind of stakeholders. So, for example, net profit matters to the equity holders. Operating profit matters for business managers. If you are running a business unit that is producing something, maybe gross profit is what comes on your head. You need to find out what the gross profitability of the firm is, right? So if you are, let's say, a unit manager, gross profit comes to your head. If you are a business manager as such, EBITDA or operating profit is on your head. You don't control policies around depreciation or interest, etc. If you are looking at as a shareholder return, you want net profit to come in. And however, if you're looking at as an analyst that wants to kind of evaluate a company where taxes are volatile, right? Tax rate changes by the government, you want to remove that, then you would look at profit before tax as the measure, because you don't know what kind of taxation regimes apply at various points of time. How has the company done there, right? And that's again more from the analysis of companies standpoint, is because taxes are not in the hands of companies. For example, in India before 2009, software companies like your Infosys, TCS, etc. used to pay a tax of anywhere between 10 to 15%, right? Now they pay a tax of close to about 27 to 30%. Now, if you look at profitability, the profitability over these years would not have moved in line with operating profits or profit before tax. But that's an external change that has happened in the business environment. You don't necessarily penalize the company for this change in tax regime. So these are the different views of profits. When a company says gross profit went up, they mean that the cost of production of the goods or service remained the same, but sales went up, or sales remained the same, but cost of production went down. When a company says operating profit went up, then general operating expenses relative to the sales went down. When a company says net profit went up, then eventual overall profitability of the company went up, right? Now, when exactly do you account for sales and expenses? Now, it's not when you receive the money. Let's say you have a business. The business, when it sells to the customer, that's when a sale is booked. A vendor, when supplies goods to the business, that's when a expense is booked, right? Now, be careful here that you could have sold the goods, but not received the money, right? that doesn't impact the sale being booked. The sale is booked as soon as the goods have left your premises and reached the customer. Correct? Note that expenses for us as a business, so expenses for us as a business are effectively sales for the vendor. So the moment the vendor has provided you with the raw materials, immediately as the raw materials come to your end, the vendor will book his sales here and you will book your expenses here. Correct? Now that is where this concept of receivable, accounts receivable and payable becomes important, because you could be selling and you could be selling and you could be selling, and your profit and loss account will keep reporting it because sales get booked as soon as you sell the stuff. But if you don't recover your money in time, that's a challenging affair for any company. You do need to keep recovering your money in due course of time, right? Similarly, it's possible that you keep booking expenses but have not paid for it. Now, in the longer run, that's detrimental to supplier relationships. And you could have examples where companies would keep on piling payments to suppliers and eventually make a default there, right? So you have to be careful when you look at these numbers, and your P&L statement only kind of puts a cover on this data. You don't know this data as if you look at only the P&L statement, right? We'll look at examples and understand that in more detail as we go along. Let's look at a sample P&L statement. Typically, you can also show it, horizontally, and some geographies show it vertically. Most of the geographies show it vertically like this, top to bottom. Some geographies call it or show it horizontally as well, where revenues are on one side and expenses are on the other side. Concepts remain the same. You have sales or revenue, then you have costs coming in. You remove the costs, you come to operating profit, EBITDA or operating profit, from which you remove depreciation, you remove interest, you remove taxes. Taxes note are on the income after you have removed depreciation and interest, and what you get is the bottom, the profit, which is the last line. Now, the profit is also referred to as bottom line of a business. Why is it referred to as bottom line for the business? Is because this is the last line in the P&L statement. Similarly, the revenue for a business is the first line, so that's considered or called as the top line in a business. So when you read top line will grow by 20%, that means revenue or sales will grow by 20%. When you read bottom line will grow by 20%, that means that net profit will grow by 20%, right? So those are the different metrics. Sale of the products manufactured by company, that's your sales. Costs are cash expenses incurred in the continuation of conducting the business operations or in the course of business operations. They could be manufacturing costs, which could include raw material costs or some part of salaries, etc. They could be administrative costs, which could be essentially selling and general administration expenses, electricity, etc. They could be sales and distribution costs, which could include marketing costs, etc. Right? You could either give a breakup like this, or you could have functional head breakups as well, where you say raw material costs, you say salaries, which include salaries of all people either producing the goods or even the HR personnel in the firm. You could put in power and fuel cost. You could put in some other costs and other manufacturing expenses and so on and so forth. It'll all add up to the same number because these are different ways of classifying costs, and what you get is your operating profit number from here, right? These are profits generated in the course of operational activities in the business, right? There's something else called as other income, which we will take at a later point of time. This is assuming that the profit is generated in the course of your running the general business of the company, right? Then you remove what is called as depreciation. These are non-cash expenses. Then you remove the interest paid. That's again accounting measure of the interest that you've paid. And finally, taxes for the period of accounting. What you're left with is your final net profit, which is the bottom line of the business, right? More on this when we kind of look at a live example and understand that in more detail. But primarily, that is how a sample profit and loss statement would look like for any given company. Next session would talk about the cash flow statement. We close this one here. Thank you.